What happens when a Federal Reserve governor publicly signals that action is coming, and coming soon? That is the question rattling financial markets today, Wednesday the 15th of July, 2026. Fed Governor Lisa Cook has made a pointed public statement. She is prepared to act soon if inflation fails to begin slowing. This is not vague Fed speak. Cook sits on the 7-member Federal Reserve Board of Governors, appointed to a full 14-year term, meaning her views carry serious institutional weight. The word soon in central bank language is not casual. It typically signals a policy decision horizon measured in weeks, not months. Today, that clock started ticking. So what has brought the Fed to this moment? Inflation in the United States has remained stubbornly elevated through mid-2026, resisting the Federal Reserve's previous rounds of rate adjustments. Cook's remarks today arrive alongside a notably different perspective from fellow policymaker Kevin Warsh, who argued separately that a one-time change in prices is not necessarily inflationary, a distinction that matters enormously for how aggressively the Fed responds. Adding to the pressure, Citigroup flagged significantly higher expenses today, sending its stock sharply lower. When a major bank is squeezed by costs at the same moment inflation refuses to cool, the Fed faces a genuinely uncomfortable set of signals pulling in opposite directions. For ordinary households and investors, Cook's statement lands with immediate, practical weight. When a Fed governor says she is ready to act, markets interpret that as a potential shift in interest rate policy, whether a hike to cool persistent inflation or a hardening signal that cuts will not arrive soon. Bond yields moved in response to her comments today, reflecting a rapid recalibration of rate expectations among traders. Mortgage holders, small business owners on variable rate loans, and consumers carrying credit card debt are all watching closely. Those groups are not waiting for a formal FOMC decision. The language from a governor of Cook's standing is itself a market-moving event. The next Federal Open Market Committee meeting will be the critical proving ground for Cook's statement. If incoming data, particularly CPI figures and core PCE readings, do not show meaningful deceleration before then, the case for action strengthens considerably. Warsh's argument about one-time price changes offers the FOMC some analytical cover to hold fire, but Cook's tone today suggests that cover is limited and conditional. The Fed's credibility on its 2% inflation target remains squarely at stake, and 2026 has already tested that credibility through several consecutive months of above-target readings. The data due in the coming fortnight will be decisive. Here is the bottom line from today's developments. The Federal Reserve is no longer in a comfortable wait-and-see posture. Governor Lisa Cook has drawn a clear line: disinflation needs to become visible soon, or action follows. For investors, that means increased volatility in rate-sensitive assets. For borrowers, that means continued uncertainty on refinancing and new credit. And for anyone tracking the wider economy, it means the decisions made in Washington over the coming weeks will directly shape financial conditions heading into the autumn of 2026. Watch the inflation data when it drops. Watch the Fed's language closely. The next move is closer than it was yesterday.